is up, my monkeys? Welcome to hopefully the first of many courses. Today we're going to be going over the Wealth Waves Future Trading, which is a beginner's guide. It's going to be teaching you guys kind of all the intro stuff, things that you need to know, lingo, how to set up brokers, what is a broker. We'll be going over all those type of stuff to get you integrated into trading. All right, so let's get started. So let's go into module 1, Introduction to Trading. Right? What is trading? Before we get into this, a lot of people, when they think about day trading, what they think about is, like going on Robinhood and buying a stock in Tesla. Like, no, that's not what day trading is. Trading is buying and selling financial instruments to make a profit. Simple as that. The types of trading that we have are day trading, where you buy and sell within the same day. Day trading. Swing trading, where you hold position for days or weeks. Scalping, which is quick trades lasting seconds to minutes, and you will figure out eventually how that's possible, how you can do that. And long-term investing, which you either hold for months or years, which is what most people think when you say that you're a day trader. They think that you're just buying stocks and hoping that it blows up by the time you're 55. If you're even alive by then, bro. So the type of markets, if you will, that you can trade are Forex, which has the word Forex means foreign exchange. If you've ever visited outside of a country, out of the USA, out of any country to another country, you understand that your dollar isn't really that useful when you get to that other country. So you go to an exchange and you give them the money and they give you whatever that money's worth, right? So for example, US dollar, I'll give them 10 US dollar. Let's say I'm going to the Philippines. They give me 5,000 in their currency because that's what $10 is worth over there. So that's what foreign exchange is. Then we have stocks, where you're buying shares in companies, you're buying pieces, right? You share a fraction of ownership in that company. People are like, oh, well, if I own 5%, does that mean I own 5% of the company? It's very fractionalized. You probably need like over billions of dollars to buy these big companies. All right, so next we have futures, right? So when most people are talking about day trading, this is what they're talking about. They're talking about futures or options. Okay, now we're not really going to dive into options as much because we personally don't focus on the options. And then of course we have crypto. Everybody knows cryptocurrency. You have Bitcoin, Ethereum, all these things. They're also tradable. They have their own markets. So why futures trading? Why do we at WealthWave do futures trading? We trade futures because of leverage. Number one, leverage. And you're going to want to learn about leverage. Leverage is so important. It can either make or break you. Leverage allows you to control larger positions with smaller capital. So essentially, if I'm looking at a 1 to 500 leverage, right, it means that for every $1 I'm putting in, it's like I'm putting $500 into the market. Now, it's good because if your trade goes right, if you have all the confluences, if you do what you need to do, you're following your rules, and your trade goes right, you can make a lot of money from a little bit of money. But if it goes wrong, the chances that you blow your account like this are very, very simple, bro. You want to watch out with leverage. You want to be smart how you use leverage. The best way I can put liquidity for you is if I had a pair of shoes that I bought and I was looking to resell, and I went on Depop and I had to wait 5 days before somebody hit me up. Because in the end of the day, when you're buying or selling, you're buying and selling actual contracts. You don't see it. You only see the chart and the money, but you are buying something there. So there has to be someone to sell it to you, right? So that's what liquidity provides. Liquidity works amazing, and flexibility. You can trade almost any asset class. With futures, you can trade Forex, you can trade stocks, and you can trade crypto. So it's not limited to only like Forex pairs or, only crypto. You can trade these various markets. So you're not limited to only one market. If you have a strategy that works better on one market, obviously you want to be able to use that market and not be cooked. So module 2, understanding futures, going deeper into futures, right? A futures contract is an agreement to buy or sell an asset at a set price on a specific future date. You're not buying the actual asset. Like I said, you're not buying in hand. If I put money into gold, I'm not getting a gold bar delivered to me. You're speculating on where the price will go. So futures versus stocks. And this is where, once again, a lot of people, when they come into trading, they think that day trading and buying stocks are the same exact thing. This is where we show you it's not. So futures versus stock, right? Futures have higher risk, More leverage, as we explained, means more potential profit and loss. More leverage allows you to control bigger positions with less money. Greater liquidity means easier to enter and exit trades fast, just going over what we talked about before. So key future markets, which are the most tradable, the ones that are always being traded, are Forex futures, as we said before, currency pairs like Euro versus USD, right? We'll go a little bit into that after this slide, after module 2. Commodity futures, which has to do with gold, oil, agricultural products, so on and so forth, precious metals, all things of that sort. Those go into commodity futures. And then index futures like the S&P 500, which if you don't know what the S&P 500 is basically just the biggest 500 companies put into one single market. That way I can put $20 into the S&P and I'm basically putting $20 fractionalized into all those 500 companies. Because it's the biggest 500 companies, it goes up, it also goes down, but it's very safe when people are looking to invest. We have NASDAQ and the Dow Jones. Right, so the benefits and the risks. Make sure you pay attention. Benefits of futures are high profit potential, flexibility to go long or short, and access to global markets. When you're buying stocks, you make money when it goes up, when the value of your share goes up, when the value of the percentage that you own goes up. That's when you make money. With futures, you make money as it goes up and as it goes down, because you can either say that it's going to go up, put money that it's going to go up, or sell, say that it's going to go down. And then the risks are that you can lose more than initial investment, so it requires discipline and risk management. Heavy on that discipline. Market mechanics, module 3. How the market works, right? We have supply and demand. If you guys don't know what supply and demand are, you're kind of late, bro. Go on YouTube, watch supply and demand. We're going to explain it right now, but make yourself knowledgeable when it comes to supply and demand, right? So supply and demand, when more people want to buy, prices go up. When more want to sell, prices go down. Very simple. All right. Then you also have price action. The movement of price over time tells you the story of the market. Now, we're not going to be talking exactly about candles in this course today, but what we will be talking about is the different types of orders that you can put in a market, right? So a market order is when you're buying or selling immediately at the current market price. So let's say that this line right here is where the price is currently at. So imagine that none of this is right here. This is market order. It's where the price is currently at, right? So if we buy right here, our order is going to be right there. That's going to be the value of our contract. And whether it goes down or up, if we short it or long, we'll make money, we'll lose money, yada, yada, so on and so forth. Right? A limit order, however, is when you set your desired entry price and wait for market to reach it. So we see this candle right here, right? This candle right here. This is where price is at the moment. Let's say that I'm like, oh shoot, it looks like it's about to reverse, go up and then go down again. Just because I got it in the dream, bro. Freaking Houdini told me. You got this line right here. You can set a limit order. What that's going to do, it's going to be like a trap almost. Or like that's a better way of I guess, saying it. It's going to be like an alarm, a trap. Basically what it's going to do when price goes up, right? You're not in yet. Boom. When price reaches here, you enter the order, you enter the market. And then whether it goes up or down, you know, whatever you did, you'll make money or you lose money. And then we have a stop loss order. Stop loss. It is in the name. It is stopping you from losing more money, okay? When you start trading, you're gonna understand that trading has to do with patterns. There are certain confluences, things that tell you where price wants to go. Let's say you make a trade and you're like, I'm 98% sure it's gonna go up. So if we look at here, we see, oh yeah, price is consolidating because it's jumping up and down, right? So I know if it breaks through, it's gonna continue to the downside. So let's say my trade is right here and I'm like, all right, bet I'm gonna short it because it looks like it's gonna go down. It just broke out. So my order's here, and then usually what you would do is you'd set your stop loss somewhere above that. Obviously it has to make sense. You only use stop losses not with how much money I'm okay to lose, but when does it not make sense? When does this trade not make sense anymore, right? So if I'm saying that if the price is gonna go down, because let's say market didn't do any of this and instead it went over here, did a liquidity sweep, and then climbed climbed all the way back up, right? Boom, takes me out of this position. I'll probably lose a couple dollars, but I'm gonna lose way less than if it were to go like this and I'm still in the position. And I was sleeping and I wake up and I'm like, oh shoot, I'm cooked, bro. I'm like down $500. This is exactly what a stop loss is used for. Make sure you use a stop loss. There's a lot of idiots out there who don't use stop loss. The amount of times that I've lost so much money because I didn't want to put a stop loss because I'm like, oh, I'm sure it's gonna go back up. Like, I'm sure it's gonna go back up. No, buddy, I got fried, bro. I got beyond fried. I got shot in the dome. Like, that's how terrible it was. So set a stop loss. I could have lost $100 rather than losing $500 on the stupid mistake. Use your stop loss. They're there for a reason. It's one of the best tools that'll help you. Now we're gonna move on into understanding bid, ask, and spreads. So bid is the highest price buyers are willing to pay. Ask is the lowest price sellers will accept. This should start making sense now. If you guys ever been on OfferUp, Depop, eBay, this should make sense. It's same idea. And then spread is the difference between bid and ask. When there's tighter spread, that'll save you money. I won't go deep into this and explain exactly what it is because there will be more course modules later on that will teach this, but just know that bid, if you're going to long or short, bid is where you're going to enter the market. And then ask is the price that you'll be selling your contract for. So if the candle is moving up and down, obviously the bid and the ask move along with it, but sometimes the spread can be so big. The spread is basically the difference between the bid and the ask. It can be so big that sometimes it just doesn't make sense. It's better to wait. And then once again, leverage and margin. We already went over leverage, but just for the sake of it, leverage is borrowing power to control larger positions. Example, 1 to 100 leverage means $1 controls $100. $100 controls a $10,000 position. Margin, the amount of money you need to keep in your account to maintain your position. This leverage and margin go hand in hand because the higher the leverage and the higher percent of your account that you're risking, which we'll go over in a minute, the higher chance that you have of getting a margin call if it goes above a certain level. Once again, margin is the amount of money you need to keep in your account to maintain your position. If I have $100 in my account, let's say I'm risking $50, right? I'm risking 50%, which is beyond crazy. If you don't have enough money to cover margins, then don't over leverage. Do not over leverage. Do not over position, right? Buy too many lots. Do not do that. And then you also have differences with like, right? Sometimes it'll stop you out, which means it'll exit you out of that position for passing like 166%. So next, module 4, we're going to be talking about trading psychology. I love psychology. Yeah. Guys, if you're happy, just clap. Who doesn't love psychology, bro? Psychology was so buns in high school. I'm not gonna lie. I hated psychology. I like psychology in the whole, like the study of humans, but bro, just terrible. Anyways, trading psychology, module 4. Your mindset matters just as much as your strategy. The best traders stay calm, focused, and disciplined, even when things get intense. For my younger audience, listen to me. When you go rizz up the huzz, bro, you can have the best game in the world. But if you're over here like tweaking and not looking confident, right? You're gonna be like, yo, what's up, shawty? You fine as hell. Like, she gonna be weirded out. You feel me? Like, you can have the best game in the world, but if you don't have the confidence that it takes to look good, bro, you're cooked. Same way with trading, right? You can have the best strategy in the world, 100% success rate, but if your psychology, if your discipline, your mental discipline is not there, you're getting cooked. You're getting folded, buddy. I'm sorry. You're getting boxed like a fishy. Right? The reason is because there will be times where you'll be in a position and you know it's going to go down, but the price might go up, or you know that it's going to go up, but the price might go down, and you're going to be negative $40. The money isn't gone until you close the position. Thread carefully though, that is a double-edged sword, right? That's where it goes into like using stop losses, where people don't use stop losses because of that exact mentality. But the money isn't out of your account until the position is closed, until you're out of that position. What does that mean? A lot of people will be trading and they'll put a trade because they feel hype, or they feel like they're FOMO, they're fear of missing out, right, out of a big move, or because they're revenge trading, which we'll explain on in a minute, right? if once again, you can have the best strategy, but if you're doing these things and you're looking at the negative $40 and you're like, oh my gosh, I know that it's gonna go down, but like, what if it keeps going up? What if it keeps going up? Oh my gosh, you close, you're cooked, and then it goes down. That has happened to me so many times, especially when I was beginning, bro. When I was beginning my trading journey, the amount of times that I closed positions because I was scared that it was gonna go up, even though my confluences were there, even though the charts were telling me that it was gonna go down, begging me to stay in that position because it was gonna go where I wanted it to go. And I closed the position and lost money and didn't make money. It's a terrible feeling. So, and that also goes like whenever you have those feelings, bro, you do not want to give into those feelings. Anyways, let's go over the slide. Your mindset matters just as much as your strategy. The best traders stay calm, focused, and disciplined, even when things get intense. Emotions versus strategy. That's what we just talked about. Don't let fear or greed, we'll talk about greed, control you. Stick to your plan and avoid impulsive trades. Why do we say greed? We already spoke about fear, but why do we say greed? We say greed because sometimes we have something called a take profit. The same way that we have a stop loss, we have a take profit. The take profit, whenever you set it, it's gonna exit your position, but a take profit's good and a stop loss is not so good. You're taking your profit out of there. You're exiting the position. Sometimes you can be really greedy and you're like, but like, you know what, that like $40 is looking really good. Let's say you know that it's definitely gonna hit a level where you're gonna make guaranteed $30, but you're like, oh, but $40 looks better. And you set your TP and the market goes down and misses it and goes up and you're just fried because you were too greedy. It happened to me so many times as well. So don't let greed control you. Stick to your plan. Make sure that wherever you set your take profit, it is reasonable. Stick to your plan and avoid impulsive trades. That also goes into fear of missing out, as we spoke before. Process-oriented trading. Focus on ticks and market structure, not your profit and loss. Trust the process, not the outcome. Profit and loss is basically the line telling you how much money you're up or down, how much money you're making or losing currently in the moment, which is where we were talking. You're looking at your P&L and you're like, oh my gosh, it's negative $40. I'm exiting the trade. And then you get fried because it just goes the complete opposite direction and then you could have made money. So focus on ticks and market structure. Market structure is where market's moving. Is market moving up or down? Why is it moving up or down? Does it make sense for me to place an order that says it's going to go up or down, right? So focus on market structure and then not your P&L. Trust that process, not the outcome. Trust your strategy. Moving on from trades, keep a trading journal. I cannot stress enough how much a trading journal is important. The reason that trading journals are so important is because you are wired to forget things after a certain amount of time. Other people are built different. They have the craziest memory in the world, but you are wired to forget certain things. So that's why we as traders like to journal. We journal our entry. We journal our stop loss. We journal our take profit. We journal why we enter, why we set our take profit where we set it, why we set our stop loss, how we were feeling when we were taking the trade, and how we were feeling when we got out of the trade. If we won, if we lost, what lesson did we learn from the market that day? Because the market is going to teach you lessons over and over again. Sometimes they're going to be pricey lessons, sometimes they're going to be nice lessons where you're going to make a lot of money, right? But regardless or not, it has a lesson to teach you every day. If you can look, open your eyes and see those lessons, you'll become better at trading. You'll become profitable in no time. And once again, keeping a trading journal helps with that because you can go look back at what you did last time that you don't want to repeat again, what you did right that helped you with the trade that you just won, so on and so forth. Intuitive reading. Read the market without fear or greed. Build confidence through practice and preparation. I mean, if you're going out to a freaking rap battle and you've never rapped in your life, right, and you're about to be a stage in a million people, you're going to be anxious. You're going to be thinking of whether you're going to fail versus the person who's training. He might be a little anxious, but he's more prepared. And that's why he's actually set himself up for success because he focused and he became confident. So mental discipline is the foundation of successful trading. Master your mind, master the markets. If you master your mind, you will master the markets. Module 5, brokers and platforms. HeroFX. The reason we recommend HeroFX is because there are a lot of different brokers and platforms. Now, HeroFX allows you to work with TradeLocker, which is the platform that we use, which is very simple. It's very, very simple. It's not gonna be like going in and that one picture of the airplane, bro. Like, it's very simple. So here's a picture of TradeLocker, and then here's a picture of MetaTrader 5, which is insane. It's good, it works good, that's why it looks crazy, but still, it's for someone beginning, it's a no-no. You definitely don't want to throw yourself into there. That's why we recommend HeroFX. We've also never had problems with HeroFX. It's our personal favorite, honestly. Quick entries, quick trading. Whenever they're updating their app, they're always telling you, always letting you know. Never had any problems with withdrawals, right? So the reason also why we use HeroFX is because of high leverage, okay? Remember, this is a double-edged sword, guys, but high leverage, 1 to 500, right? So trading with massive buying power, even if you start with a small amount. Hero 10x account, instantly 10x your trading capital with no profit splits or challenges, right? So what this does is a Hero 10x, let's say I have $100 and I buy a $100 account, it's gonna 10x that and give me $1,000. The only difference is that account is gonna have $1,000, but if I go below a certain amount, it'll close the account and I can't use it anymore. It closes the account completely and I lose my money. And then it's also, it's worth it sometimes if you don't have a lot of money, but if you have money in your like live account, you don't really need a funded account, because funded, they're gonna mess you up with like your leverage and something like that, right? Where you're trading in the live account, where you're trading with 1 to 500 on a Hero 10x account, you'll normally be trading with like 1 to 15, 1 to 1, like not that much. So personal matter, personal opinion. If you want to, go ahead. If you don't want to, you really don't need to. Now we're gonna get into the juicy part, the raw/zero spreads. Okay, we spoke about spreads. You know what spread is now, right? Sometimes spread can really mess you up, which is why we enjoy the benefit of having raw spread. Raw spread means you don't get any spread at all. And then you also have the zero fee account, which means you trade without any fees. Whenever you close a position, the position doesn't get any fees taken out of it. It's a win-win, because the one with zero fee, you get a lot of spread in it. And I mean, it's personal opinion. We definitely prefer the raw spread account versus the zero fee account, because I'd rather pay like $5, $6, $10, $100 if I'm making like a crazy trade in fees versus getting my position messed up and losing a lot more. Like, then we also have platforms. So then we also have the platform which we were talking about, TradeLocker, right, which is integrated with TradingView. If you guys have seen those videos of people charting on YouTube or TJR, they're using TradingView, right? TradingView is amazing in the way it works. We'll talk about that later in another module. But yeah, TradingView is good, or MT5. It also works with MetaTrader, but MT5 is like walking into the cockpit of an airplane and trying to understand it for the first time. Like, it's going to be insane, but it does have fast execution and seamless charting. It does help with that. You also have 200 plus trading instruments, right? You have Forex, majors, minors, and exotics. We'll explain what that is in a minute. We have indices and stocks, right? Like NASDAQ, Apple, Tesla. You can make money on those too. You have commodities and crypto like gold, XAU, Bitcoin, Ethereum, XRP, Solana, so on and so forth. And then we have easy funding and low minimum, very low minimum, right? Some places you have to put $50 into your account. These starting as little as $5. I'm pretty sure sometimes it can even go lower, but it's very beginner friendly, very easy. Right here, you can sign up. It uses our partner code, which really helps us out. And that in turn allows us to help you and give you this content and teach you how to trade and make that big moolah. Make that big bow. I'm a big dog. Module 6, setting up TradingView. TradingView is the most popular charting platform for traders worldwide. It's intuitive, powerful, and connects seamlessly with HeroFX. Yes, it does. Searching and adding pairs. Type any trading pair in the search bar to pull up its chart instantly. So right here, I'll show you guys a real quick picture of what TradingView looks like. Whenever you enter there, you're gonna go into the search bar. You're gonna search up Bitcoin or whatever you're looking to trade. It should pop up. Make sure it says Forex or futures or so on and so forth, and you'll be able to see it in there. Chart. It has a lot more stuff than, for example, like TradeLocker. TradeLocker uses TradingView's system It has it integrated into it, at least with the charting. But TradingView has a lot more indicators. It's much better when it comes to trend lines and doing everything that you do when you're charting out your chart. And yeah, so yeah, basic chart tools, as we were saying, and templates and alerts. You can customize your own chart layouts and set price alerts so you never miss a trade. Pro tip, save your favorite charts set up as templates for quick access. This saves time and keeps you consistent. Although normally it just literally saves it for you. So all you have to do is like exit out and it like automatically like backs it up to the cloud. But yeah, guys, I heavily recommend if you're going to be charting, do not chart. You can chart on Trade Locker, but I heavily suggest you instead chart on TradingView and use the better indicators and all these things, because sometimes there's things you can't see that you can see with good indicators, like ICT concepts. All right, understanding trading pairs. I keep like going my hands together like I'm that fly. Anyways, we have Forex majors, right? So with Forex, we have Forex majors, Forex minors, and Forex exotics, right? So Forex majors, they're the most big ones, are the most traded pairs, like Euro to the USD, GBP, Great British Pound to the US dollar, and US dollar against the Japanese yen, right? Forex minors, cross-currency pairs without USD, like Euro, GBP, AUD, NZD, so on and so forth. Then we have Forex exotics, right? Emerging market currencies like USD ZAR, Euro to TRY, and USD to MXN. Then you have commodities like gold, silver, oil, physical assets with real world value, right? Things that back up the currencies that we use in a day-to-day basis. Indices, right? Market baskets. That's why they call remember, S&P 500, it's a total of 500 companies. That's what they're called, market baskets, because it's like a basket of all the big companies. NASDAQ, Dow Jones, and then with crypto pairs, BTC, Bitcoin, Ethereum, XRP, a lot of digital currencies trading around the clock, and those are 24/7. So pair correlation and volatility. Some pairs move together, positive correlation, while others move in opposite directions, negative correlation. Understanding this helps you manage risk and diversify your trades, right? So if I'm trading Great British Pound versus the USD, and the USD does bad, the Great British Pound is going up, right? If the USD is doing good, GBP USD is going down. We call that GU for short, but GU is going down if the US dollar is doing good, because they trade against each other. Now, choosing the right pair for beginners, you want to start with Forex majors because they're liquid and have tight spreads a lot of the time. For volatility, which once again, double-edged sword, can make or break you. Volatility means it's moving up and down like in crazy amounts, but sometimes those are hard to read, and that's more gambling. So you do need to be a little bit more in tune with the market. But yeah, for volatility, you could try exotics or crypto for bigger price swings, or for stability, stick to indices or commodity futures, right? Things like S&P 500, NASDAQ, Dow Jones, so on and so forth. Now you can start talking like us. Let's break down the common terms you'll see in trade alerts and discussion. No confusing jargon, just simple definitions. So first we have number one is long. So long is buying an asset because you think the price will go up. Basically, going long is saying that the market's moving like this, right? It's moving up. This is going long. Take a moment to appreciate my handwriting on my keyboard. Now, if long means going up, then you can already guess that short means going down, right? It's short right here. So long means going up, short means going down, right? Selling an asset because you think the price will go down. What you're doing is you're selling it at the moment for the price that it's at, and then if it goes down, it's worth less. You buy it back for a lesser price, you make money. Leverage, which we've said so many times in this, borrowed money that lets you control bigger positions. Margin call, you guys are gonna learn real quick what a margin call is. A margin call is a warning from your broker when your account is running low on funds. So when you have low margin, right, if you're over 100%, you're getting margin called. You need to add money. Usually they'll give you a bit more space to make some money, but if you pass that 166%, you're cooked. Pip is the smallest price movement in Forex, usually 0.0001, because we're moving in price, right? Price numerical, we're moving up, and a pip is really small. So lot, the size of your trade, we've already spoken about this. The standard lot equals 100,000 units. Stop loss, which we also spoke spoke about, an order that automatically closes your trade to limit losses, and take profit, an order that automatically closes your trade when you hit your desired profit target. Now, here, listen to this very carefully, and I want you to write in your notebooks here now. When you see a wealth wave alert, it will include an entry, the price level to enter the trade, stop loss, where to exit if the trade goes against you. Module 9, taking calls and following alerts. Wealth Wave provide trades called based on high confluence setups. Here's how to follow them confidently and manage your risk. How Wealth Wave trade calls work. We analyze the market and send you alerts when we identify strong trading opportunities. This is what an alert or a signal is. Identifying high confluence setups. Look for multiple factors. This is our job. Our job is to look for multiple factors aligning with trend, support, resistance, indicators, ICT concepts, all pointing the same way, saying that it's either going to go up or down. Understanding risk to reward ratio. A good trade should risk 1 to make 2 or more. This is called a 1 to 2 risk to reward ratio. If my stop loss is at $20, that should mean that my take profit should be at 40. Anything below that, you can do it, but it's just not recommended, because at that point it's like you're risking, what are you risking it for? Position sizing and risk management. Never risk more than 1.1 to 2% of your account on a single trade. This keeps you in the game long term. Of course, this is what a lot of people say. I personally risk 5 to 10% of my account. That's just how I risk it. That's what I've seen success doing. Try not to over leverage. This is what over leveraging or over positioning is. Do not over position. Don't go higher than 10%. Sometimes those numbers will just look at you and beg for you to risk more of your account. Please don't, bro. I'm telling you, do not do that. And then this is an example of an alert breakdown, but of course you can see it here. We have all these multiple channels. You can see all the alerts there and see for yourself, get yourself used to that. All right, and module 10, next step in best practices. You made it, dude. You made it to the end. Congratulations on completing the first course. Now it's time to put your knowledge into action with confidence and discipline. So here's a little things that we at WealthWave would like you to do. This would be very nice. This would help you. And of course, the more we help you out, the more it helps us out. So of course, we want you to help yourself out. But if you don't want to help yourself out, then you're good. I don't even know why you're watching this guy. Anyways, number one thing that we recommend is creating a trading routine. Set specific times to check charts, review alerts, and journal your trades, right? Normally, we like to wake up traders at EST. I'm going to be talking Eastern time here. 8 is a good time to wake up. If you're in bed and you wake up, you can do what you got to do, make some breakfast, and then have some time to sit down, see the charts. The market opens, okay? Wall Street opens at 9:30 a.m. EST. That's when most of the volume is coming in. So make sure to see when 9:30 is for you in your time zone, and then do what you got to do from there. Understanding market news. Stay updated on economic events that move markets, like interest rates decision and employment reports. Very important. And at the end of the day, market has to do with money. Money has to do with economics, right? Economical events going on in the globe. It will affect the market. It could decide whether you make a lot of money or you lose a lot of money. So stay informed. We recommend things like Forex Factory to check out all your market news. One of the best out there. Everybody uses it. Journaling trades, which means writing down every trade, like we explained before. Entry, exit, emotions, lesson learned. This is how you improve. This is genuinely how you improve. This is what sets apart profitable traders from unprofitable traders. And then community participation. Learn from other traders, ask questions, and share experience in the WealthWave community. Please, I beg of you, we are here to help you. We are building a community. We are a community. We understand this. We understand that you might not understand this. Maybe you do, but maybe you also don't. We're here to help clear any misconceptions, any questions you have, anything. We're more than happy to help. So please reach out to us, DM us. We will never DM you, okay? Admins will never DM you. If you're getting DMs from anyone that looks like us, it's a scam, unless, I told you in the server I was going to DM you. But yeah, feel free to DM us. We check our DMs pretty frequently, our requests. At us in the server, we check the server pretty frequently as well. We can help you with whatever questions you have. So for the end and the conclusion, start small, practice, and grow. Realize how I said start small. Don't start big. Don't put $100 and risk the $100 thinking that you're gonna hit it big. You're not trading, you're gambling, buddy. If you really want to do that, go on RayBet. Don't do this on here. Begin with small position sizes. Focus on learning, not earning. Focus on learning, not earning. My guy, if you want to be a doctor, you've got to go through a couple years of school, dude, right? If you want to be a trader, you're going to have to go through a couple months of just learning and not making really any money, or making money. Actually, as a matter of fact, let me rephrase from that. We have our calls. Our calls here at WealthWave, our signals, which we are about to learn how to take, are going to allow you to make money while you're learning, okay? But don't just rely on our signals. Learn, take the courses, communicate, do all these things, and then you'll be able to go off on your own and make your own trading journey and become profitable and a millionaire. We're here to teach you how to fish, not hand you the fish. We're going to hand you the fish while you're here, right? If you're coming to summer camp to learn something, obviously I'm going to feed you, dude. But if you're here to be fed and not learn how to catch so you can feed yourself, then I'm sorry, you're cooked. Get out. All right. Anyways, every expert trader was once a beginner. Your journey starts now. Take it one trade at a time. Take it one trade at a time. Dude, I know sometimes it feels like we need to get rich now because of how this day and age is built to make us think. You see all this luxury cars online. You have to do something for yourself. You see it online and you know that it's possible. But don't go crazy trying to achieve that. Go as far as possible. But also take it easy on yourself sometimes too. Because sometimes that mentality can put you in really dark places. To trade, you need to have a nice mentality, a good mentality. Keep yourself up there. Keep yourself humble. Understand that you're a beginner. You're not going to make crazy racks. Maybe not even like soon into this. But just know that you're investing into that possibility. You're investing into that future. And that future is going to come if you do it. It's 100%. There's no way it won't come if you do what you have to do. If it doesn't, then that's your fault, dude. I'm sorry. I'm not sorry, actually. You should be doing what you got to do. Every man for himself. But of course, we're here to help you, so always that. Anyways, this was the first course, Intro to Trading. We went over a bunch of things. We went over markets. We went over brokers, TradingView, a bunch of other things. If you didn't understand something, feel free to watch this again or DM me, of course, or DM any other admin in the server, or even DM in the general chat or the trading discussion. We'll be more than happy to help. Yeah, I hope you enjoy your day, your night. I hope this gets you excited to really start the trading journey. I'm going to be trying to post these daily, if not weekly. And yeah, let's all grow together. Peace out.